Hey guys, just wanted to share something with you really quick. I had a um, client bring basically a scenario to me that I had to dig into a little bit, and I just wanted to share some of that with you guys and the analysis on that. And basically, what it was is the client has a home that they're set to inherit. That the home's worth approximately $450,000, a little bit outdated, great area of local city, and the home is currently being rented and it's paying for long-term care for the owner of the property who is actually 100 years old. And one of the things that's pretty neat here is they're obviously using the home to pay for long-term care, but considering re-renting the property until they inherit the property and then look to potentially sell the property. Um, so the idea here was brought to me to just say like, hey, what can the property rent for? This is what we're looking to do. But I dug a little bit more deeper into this to see like what's the analysis here? Like what happens if somebody keeps this property as a long-term investment into the future? What if they do sell it? What could they do with the money to reinvest? That type of thing. So some of the things that come up in a scenario like this is just, do you keep it? Do you sell it? Right? What are the headaches? What are the pros and cons? What are the tax implications? What's the return on investment? And then I think when I really dug into this a little bit more, what it comes down to is control, right? Depending on where you put your money, what you do with your money, what type of control do you have? Do you want? What type of um, active involvement do you want in an investment? Some people want no involvement, just want to check. Other people, want to have a little bit more involvement because they're looking for a little bit better rate of return. So anyway, couple of things I had to dig into here was um, if you were to sell a property that was worth $450,000, you'd have roughly $50,000 in cost to sell the property, which would net you out about 400 grand, right? Between real estate sales agents, so on and so forth. And if you were to take the $400,000 and you were to invest it in a vehicle in the stock market, that would be low fees and pay reoccurring cash flow to the owner, because that's what real estate does, it pays cash flow. You would have to invest that in some type of dividend yielding stock. So there's a lot of ETFs out there that have low fees, and their fees range from a 0.1% to 0.5%. So that's where you'd want to be, right? And if you look over the, let's see, 50-year, over the average of all times in stock markets with dividends, they basically pay not falling below 3% yield, which basically means if you had $1 million in dividend stocks, that you'd make $30,000 a year. So you can do the math on that. But here recently, it's fallen to just below 2% there. And if you take the 2% into account and you subtract off the 0.5% fee, you're looking at 1.5% here is what you would earn. So if you had $1 million in ETF funds and you were charged 0.5%, you'd be making $15,000 a year with $1 million invested there. So the other thing I had to look at was, well, what about general stock market, right? What's the average stock market returns adjusted for inflation over time? So we looked at here, just quick Google search. If you adjust for inflation, historical average, the S&P 500 since before the Great Depression has been 7%. So not bad. But you definitely have to take into account the fees. Most fees on these mutual fund stock portfolios are going to be anywhere from 0.75 to 1.5 fees for the management of that. So if you just take into account a 1% fee, you can look at what the investment returns on a $400,000 portfolio would be. At 6%, it's going to give you $716,000 over 10 years. And that's what we had to basically look at to then go and look at the real estate as an investment and say, well, what are our implications there, right? So we basically drew this all out on a spreadsheet, took all the costs into account. But one of the things maybe first to think about is, what are the tax implications if you inherit a property? Well, do you pay capital gains tax, which is anywhere from 15 to 20% during this current time? So if you inherit a property, typically what would happen is you would have the property appraised at the current value, which is basically stepping up the basis of the property. So even if family members bought the property for, say, $100,000 and now it's worth $450,000, you're not going to pay, the person who's inheriting it, it's not going to pay taxes on the $350,000. You would basically get an appraisal on the property, show that the property is worth $450,000, and that would be your new basis on the property. So basically, if you were to then sell the property, let's say 2 years later, and it was worth $500,000, you would pay taxes and capital gains on the difference of the $450,000 to $500,000. So you pay taxes on the 50. If you were to sell it immediately at basically at the new basis, there's no capital gains because it's worth $450,000, sold it at $450,000, no capital gains. Okay. Similar idea goes into stocks. If you buy stocks, buying $400,000 worth of stocks, stocks go up in value to $1 million or this 716. When you cash out of that stock, you would basically pay capital gains on the difference from where you bought the stock at to where it ended up at. So in this case, basically the $316,000, you'd pay capital gains on that. There are some neat things you can do with basically estate planning, where these things can possibly be passed on, little or no tax. Same thing with the real estate. So let's go ahead and dive into the real estate. So this is what we're looking at from a real estate side of things. So we put in our $450,000. That's the price of the property after repair value. That's what ARV means. There's no purchase price because the property is inherited. And what we want to pay attention to is what the property is going to rent for. So we're putting in, we think, a range of $2,000 to $2,800. So we put it right in the middle. We go $2,400. Annual increases over time of 1%. And so we're just basically looking at that. We've plugged in some key metrics here for any real estate, and we were very, very conservative on this property. So we put in a 12% vacancy rate on an annual basis, which we can drive that lower by signing longer term leases. So basically what that means is every year there'd be a month and a half that the property was vacant and or not paying rent. We've got our annual taxes, our insurance, and some utility cost. Average maintenance cost for the property, factoring in 11%. It's just some historical data that we've got. You've got a management fee and a leasing fee for the management company to rent the property out. Again, this is renting the property out every single year, which is not necessarily the case. That could be offset by signing 2-3 year long leases that lower that cost for somebody, and or somebody could be self-managing the property in this instant. One of the things that most residential landlords or investors do not factor into their properties or their analysis is this thing is called capital expenditures. So it's CapEx. And basically what that is everything in the house, the roof, the AC, the windows, the lights, the plumbing, it all has a useful life. And basically, no matter how good a tenant takes care of a property, the things are going to wear out. And you're going to have to factor in those costs. So when the roof needs to be replaced, you've got the money to basically pay for the roof to be replaced. So what we've done here is we factored this in here in this capital expenditures table here. And what you'll notice if you just look at this really quickly is you'll notice that I've removed the roofing and the HVAC from this calculation, and I've plugged it back in into a different spot. The reason that I've removed those is because the owner has recently done those renovations to the property. So they're not going to see those costs again for another, basically 15 to 30 years. So I've gone ahead and plugged them back in here at year 15 for the HVAC system, and then here year 30 for the roof. So basically they're big cost in those years, but it's lowering the CapEx on a monthly basis here. So these are annual figures here. All right, and then so we take all of that into account, and what it's showing here is that being very conservative with how long the property is going to be vacant, having a property professionally managed, having all of the maintenance accounted for, and having all of the capital expenditures accounted for, so there's no surprises. The landlord here would basically get $1,000 a month, every single month, like clockwork. Okay. And then you can look at here, average inflation is going to drive up home prices 1.5%. That's across the entire United States. Areas like where this property is located, the appreciation is done a little bit better than the 1.5% over time. But again, being ultra conservative here. So you can see in 10 years time, the property would be worth roughly $520,000. And the cash flow that would be generated from the property would be about $128,000, $130,000 there, give or take. So you just add those together, and you can see that's basically, you can see it down here at the bottom. So it's $650,000. So it's pretty good. And our returns, because the property is inherited, are infinite. That's why you're seeing the INF there, right? So one of the things and strategies that really comes into play with rental real estate is you can kind of have your cake and eat it too, because you've got the underlying asset and you've got access to capital in the form of equity through what's called a cash out refinance. The cool thing about a cash out refinance is you can pull cash out of a rental investment and not have to pay any tax on that money. So you could literally pull all of the equity out of a property if you could find a lender that would lend 100% loan to value, and you could pull all of that money out and use it for whatever you wanted. Go on a fancy trip, buy a yacht, whatever the case may be, pay for long-term care, pay off debts. You can use it for whatever you want. There's no taxes, right? And the beautiful thing about rental real estate is you can put a tenant in the property, and the tenant basically over time will basically pay back that loan, so you're not having to pay back that loan. So that's pretty cool, along with being able to depreciate the rental asset. So what I wanted to show here is, what does that look like if we take money out of the property? So I've already figured this out a little bit, but if we were to say, hey, we want to take $200,000 out of this property at today's rate, so we'll put 200 grand in our pocket. We're going to have a loan on the property. There's going to be some closing cost. In here, I've got it as this down payment amount, but I did that having to manipulate the spreadsheet a little bit here. But that's about what it would cost you to close that. And then you'd probably get 3.5% interest rate or better for 30 years on the property. Okay. So what that's going to show you now is your cash flow that you're getting every month. You're still going to account all of the same numbers that you were accounting before, but instead of $1,000 in your pocket, you're basically going to have 140-ish dollars, 141 in your pocket every month. Doesn't sound great, but at the same token, it's allowing the property to increase through appreciation. You've got debt pay down because the tenant's paying down the debt again. Um, and you're still getting a return on the investment. You still have control over that investment. So kind of what does that look like? So now you can start to see where the math is starting to work, where it's not infinite anymore because you've actually got a loan on the property. It's showing you that basically you're making 42% on your money through cash flow. You've got depreciation of the property. You're getting big advantages in debt pay down because the tenant's paying down the debt, and it's allowing you to sit on the appreciation on a house that's worth, again, at that current time, $450,000. So we look down here at our return on investment calculator, and it's basically showing us that we're doing really well for ourselves here on this property, still cash flow positive, still paying for all the capital expenses, still paying for all the vacancy rate, still paying for the professional management. It's still taking care of everything itself. And you've got control of the asset. And so what I mean by control of an asset is that if you own stocks in the stock market and the stock market went down, your only control in that scenario is to cash out the stock, trade it for another stock. And when you cash out the stock, you'd probably have losses, which would be helpful tax purposes wise, but you'd have to buy another stock. Okay. Like you can't go in and tell the CEO of the company how to run the company, how to make their stocks perform better. Like you don't have that type of control. In rental real estate, really the only things that are going to impact a rental real estate is a tenant not paying the rent, a tenant damaging the property, which there's insurance for, or a property manager not properly managing the property. And if you're self-managing it, you could take that variable out of there as well. So the control that you have there is to essentially take somebody to court for an eviction, find a new tenant, put in the property, hire repair guys to fix the property, and basically put the property back into function, into a performing asset. So you have a lot more control. So basically what I'm looking at here is my final thoughts on this is you would make more money working through the rental real estate on this one, but you would have to be a little bit more involved, maybe not in the day-to-day aspect of things, but definitely, month to month, quarter to quarter, you'd have to pay attention to your income and expenses, right? And I think you probably have to do the same thing, even if you're in the stock market, working in ETFs. But I think you have a lot better opportunity by doing this cash out refinance program, holding on to the underlying asset and working through that than you would putting the money in the stock market. Going to make a little bit less yield in the stock market long term. But again, this was an analysis, so you can go and do your own homework and just see what makes sense to you. And I do think it all comes down to control. Which one do you have more control over of your financial destiny? And the way I look at it, rental real estate is much more controllable than stock markets and stocks and other asset vehicles like that. So I hope you found this interesting. Take care.